Right now, at flight schools across this country, something is happening that doesn't get nearly enough attention outside of the training industry itself. Piper Aircraft has been expanding its presence in the U.S. flight training market in a deliberate, measured way, adding more trainer aircraft to school fleets, deepening relationships with academies, and positioning itself as the manufacturing answer to a demand problem that's been building quietly for years. And the reaction from most of the general aviation press has been pretty predictable. Here's the announcement, here's the model designation, here are the delivery numbers, thanks for reading. What almost nobody has done is sit down and actually think through what this move means, what it tells us about the underlying state of flight training demand right now, what it says about where Piper is placing its bets and why, and what the implications are for everyone connected to this market. From the student sitting in a Redlands classroom trying to figure out how to pay for instrument time, to the regional airline recruiting coordinator trying to figure out where the next wave of qualified applicants is actually going to come from. That's what we're doing today. And I want to take my time with it, because this story has layers that the press release version completely misses. And if you're involved in flight training in any capacity, whether as a student, an instructor, a school operator, an investor, or just someone who pays attention to where this industry is actually heading, the details matter a lot more than the headline does. Hit subscribe before we go further, because this is exactly the kind of market layer breakdown that I specialize in, and if you want to understand what's actually moving in aviation manufacturing and training demand, rather than just what the marketing materials say, this channel is where you want to be for every video going forward. Let me set the stage first, because you can't understand what Piper is doing without understanding the environment they're doing it in. Flight training in the United States has been under an almost paradoxical kind of pressure for the better part of the last decade. On one hand, you have the loudest, most urgent pilot shortage conversation this industry has ever had. Regional airlines posting signing bonuses that would have seemed impossible 15 years ago. Major carriers fast-tracking upgrades on timelines that used to take a full career. Aviation universities expanding enrollment aggressively. The military pipeline producing fewer graduates than the commercial sector needs to absorb. Aviation media running story after story about how the industry is burning through pilots faster than it can replace them. The demand signal from the downstream side of the training pipeline has never been clearer or louder. On the other hand, the actual machinery of training that demand, the schools, the instructors, the airplanes, the airspace, the infrastructure, has struggled badly to keep pace. And one of the most fundamental, mundane, and consistently underreported pieces of that struggle has been simple airplane availability. Training aircraft, the basic piston singles that students learn in, the ones that accumulate 1,500, 2,000 hours a year in pattern work in cross countries and instrument approaches, the ones that are, right now, old. Older than many of the students flying them, older than some of the instructors teaching in them. Running on airframes and engines that were built when the training demand environment looked completely different and nobody was planning for what the industry actually needs right now. Walk into a typical Part 141 flight school today, one that isn't attached to a major aviation university, with deep corporate sponsorship, and look at the ramp. What you're going to see, more often than not, is a fleet of Cessna 172s and Piper Warriors and Cherokees that were built in the 70s and 80s, maintained carefully by hardworking mechanics, kept legal and airworthy, but showing every year of their age in the things that don't show up on the maintenance log. Worn interiors. Analog panels that take longer to train on than the glass cockpits students are expected to operate when they hit the regional airline seat. Avionics that are serviceable, but increasingly mismatched to what airlines actually want to see in a pilot's training background. And most importantly, airframes that are accumulating hours in a demand environment they were never designed for, because when they were built, the pipeline didn't look anything like this. This is the backdrop Piper is walking into, and understanding it is what makes their move interesting rather than just routine. Piper's trainer lineup centers primarily around the Archer and the Seminole, and for decades those have been staple aircraft in professional pilot programs, specifically because of what they represent in terms of transition training. The Archer as a complex, capable single, the Seminole as the light twin that gives students multi-engine time in an airplane that's docile enough for training, but realistic enough to build genuine skill. These aren't flashy airplanes. They're not the ones that generate excitement at air shows or viral footage on aviation social media. They're workhorses, built to be flown hard, maintained efficiently, and flown again the next day without drama. And that is exactly what a serious training fleet needs. What Piper has been doing in expanding deliveries into the school market is responding to something real. Flight schools are buying. Not in the cautious, one airplane at a time way that characterized a lot of the pre-pandemic years when money was tight and demand projections were uncertain. They're buying in fleet quantities, in some cases replacing aging single-engine fleets almost entirely, in other cases adding capacity that simply didn't exist before because student enrollment has outgrown the airplane count. And the question worth sitting with is why now, and why at this pace, and what that tells us about where training demand is actually headed. Let's start with the enrollment numbers, because the underlying driver here is student volume. And the student volume story right now is genuinely remarkable if you're paying attention to it closely enough. FAA data on student pilot certificate issuances has been in a broadly upward trend for several years, with some variation year to year, but a clear directional movement. The pipeline is larger than it was a decade ago, and the growth isn't coming from one single demographic or one single motivation. Yes, there are people in the pipeline specifically targeting airline careers, and the ATP pipeline has been getting a lot of the attention. But there's also been real growth in the private pilot segment, in recreational and sport flying, in people who left aviation before completing certificates and are coming back under better financial circumstances, and in international students who are choosing U.S. flight schools specifically because the training infrastructure here, for all its current strain, is still among the best in the world. When you add all of those streams together, what you get is a demand picture that isn't just about the airline shortage. It's broader and more durable than that single narrative. That breadth matters for understanding what Piper is doing, because a school that's buying Archers to serve ATP track students, and a school that's buying them to serve private pilot candidates, and a school that's buying them to serve international students, all show up as the same demand signal on the order books, and that means Piper isn't dependent on any single thread of the enrollment story holding up. As long as the aggregate student count keeps growing, and right now there's every reason to think it will, the demand for training aircraft is real and durable. Now let's talk about the fleet age problem specifically, because this is the part of the story that's driving urgency in a way that pure enrollment growth alone wouldn't. The average age of training aircraft in the United States right now is genuinely striking. We're talking about fleets where the median airframe age runs into the 40s of years in some cases. 50-year-old training aircraft aren't unusual. These airplanes have been maintained, and in many cases maintained very well. But maintenance costs on aging airframes don't stay flat. They compound. Every year, the inspection findings get a little more expensive. The parts get a little harder to source. The time the airplane spends in the maintenance shop rather than on the ramp gets a little longer. Engine overhauls on older training engines are coming due at intervals, and the cost of an overhaul on a high-time training engine isn't a small number. And all of that maintenance burden falls on a school's operating margins at exactly the moment when instructor salaries are finally starting to reflect the shortage in the instructor market, meaning schools are getting squeezed from both directions simultaneously. Here's the calculation that's changing the fleet replacement conversation at schools that used to just keep maintaining what they had. When your per-hour maintenance cost on a 40-year-old Cessna keeps climbing because of squawks and corrosion findings and aging hoses and aging electrical systems, and you're paying a new instructor meaningfully more than you were 3 years ago because the market for flight instructors has genuinely tightened, and your rental revenue per hour has a ceiling determined by what your local market will support, at some point, a new airplane with a warranty, with a predictable maintenance cost profile, with current avionics that cut down on training time for glass transition, and with a significantly lower hourly maintenance burden, becomes financially defensible in a way it simply wasn't, when old airplane maintenance costs were lower and the instructor salary pressure was less severe. That calculus has shifted at a lot of schools over the last 2 or 3 years, and Piper is in the right place at the right time to capture it. Let's get specific about the Archer for a minute, because the Archer is doing the most work in this expansion, and it deserves a close look on its own terms. The Archer TX is the current production version, fitted with the Lycoming IO360, and critically for the training market, offered with the Garmin G1000 NXI as a standard equipment glass panel. That's not a minor detail. That's a fundamental part of the value proposition for professional training schools specifically. When a student trains for their private, instrument, and commercial certificates on a glass panel that matches, at least in family and interface, the avionics they're going to encounter in airline training, you're reducing friction in the transition from training aircraft to airline simulator to airline aircraft. Airlines know this. Regional hiring departments know this. And schools that are serious about producing graduates who are ready to compete for those seats know it too. Which is why the glass panel question has become a much bigger factor in fleet purchasing decisions than it was 10 years ago. There's a secondary benefit to the glass panel that doesn't get talked about as often but is genuinely important for school operations, which is the data. Modern glass avionics collect flight data in a way that older analog panels simply don't, and progressive schools are using that data for safety monitoring, for instructor performance review, for identifying patterns in student errors during approaches and departures, and for insurance purposes. An airplane that generates usable flight data isn't just a training platform, it's a management tool for a training operation that's under real pressure to demonstrate safety culture to insurers who are becoming meaningfully more scrutinizing of flight school operations. That data capability has real dollar value to a school operator even if it doesn't show up on the spec sheet in an obvious way. The Archer also benefits from something that's easy to underestimate, which is parts and service network familiarity. When a school has been running Pipers for 20 or 30 years, their maintenance staff knows these airplanes. The shop has the tooling, the mechanics have the experience. Switching manufacturers isn't as simple as signing a new purchase agreement, because it also means retraining maintenance staff, potentially retooling, potentially dealing with a service center network that's farther away or thinner in coverage. Piper's established service network and the deep institutional familiarity that a generation of aviation maintenance technicians has with these airframes is a genuine competitive advantage that doesn't disappear just because a competitor builds a technically comparable airplane. Fleet inertia is real, and Piper benefits from it in ways that are hard to quantify on a single line item, but easy to see in aggregate purchasing patterns. Now let's spend some time on the Seminole, because the multi-engine piece of this story is actually where some of the most interesting demand dynamics are happening right now. The Seminole has been the dominant light twin trainer in professional programs for a very long time, and its position in the market is being reinforced by something specific happening in the airline hiring environment. Multi-engine time matters at hiring interviews. It's not the only thing that matters, and ATP track students have various paths to build it, but a student with solid Seminole hours in their logbook and a multi-engine instrument rating built in a real training environment is a more competitive applicant than one without it, and schools that can offer a complete training pathway from private through multi-engine commercial and instrument are in a stronger position competitively than those that cap out at single-engine training. That has schools that might have previously skipped multi-engine training entirely, now adding Seminole capacity, which shows up directly in Piper's order books. There's another angle to the Seminole's demand story that deserves attention, which is the international side. The United States remains a destination of choice for international flight training for students from countries where domestic flight training infrastructure is inadequate to serve the demand from their own commercial aviation growth. Southeast Asia, South Asia, Latin America, parts of Africa, these regions are experiencing commercial aviation growth that their domestic training pipelines can't serve fast enough, and students from those regions are coming to the U.S., enrolling in professional programs, getting their certificates here, and then going home to fly for carriers that desperately need them. Those international students need multi-engine time just as much as domestic ATP track students do, and the schools serving international populations have been among the most aggressive buyers of Seminole capacity over the last several years. Piper knows this, and the targeting of the school market with both platforms simultaneously, Archer for the bulk of flight training hours and Seminole for multi-engine progression, is a deliberately integrated strategy rather than two separate decisions happening in parallel. A school that buys Archers from Piper and builds a relationship with the manufacturer and the service network is a school that's already primed to add Seminoles when enrollment justifies the next step, and Piper's sales organization understands that lifetime school value is significantly higher than any single fleet purchase. Let's zoom out now and talk about what's happening competitively, because Piper doesn't operate in a vacuum, and the training market isn't theirs exclusively. Textron Aviation, which owns Cessna, has the 172 Skyhawk and the 182, and the 172 is the single most widely used trainer in the history of American aviation. That's not a title you displace quickly or easily. The installed base is enormous, the service network is comprehensive, and the familiarity of the Cessna brand in the training context is so deep that for a lot of schools, particularly smaller ones, serving the recreational and private pilot market rather than the professional pipeline, the default conversation about fleet replacement starts and ends with 172s. Piper isn't trying to pull every school away from Cessna, and anyone who frames this as a direct battle for the same exact customer is missing the nuance of the market segmentation. Where Piper is specifically competitive is in the professional training segment, the Part 141 programs that are building airline-ready pilots, the university-affiliated programs that serve a high volume of students on an accelerated timeline, and the larger regional schools that operate big fleets and care a lot about per-unit economics over the life of an airplane. In that specific segment, the Archer's handling characteristics, its suitability for IFR training, and its positioning as a step toward more complex aircraft give it genuine advantages over a 172 for certain training missions. Neither airplane is universally better for all training purposes. They serve overlapping but not identical missions, and Piper is smart to focus its fleet expansion marketing on the segment where the Archer's characteristics are most clearly differentiated. Diamond Aircraft is another player worth mentioning, particularly because of the diesel engine angle we touched on in other contexts. Diamond's DA-40 and DA-42 have significant penetration in the university training market, particularly at programs that value the diesel fuel flexibility for international students who may need to train in environments where avgas is less reliably available. Diamond has real customers and real relationships in the professional training space, and in specific markets and specific program types, they compete meaningfully with both Piper and Cessna. But Diamond's service network in the U.S. is thinner than either of the American manufacturers, and for a large school running high cycles on a tight maintenance schedule, service network access matters enormously. Piper benefits from being the most American of the remaining American-identified trainer manufacturers in a market where that relationship with the service infrastructure is a genuine operational factor. There's also a category of new entrants and adjacent competitors that's worth acknowledging, though their actual impact on Piper's fleet sales right now is more potential than realized. Companies developing next-generation electric and hybrid trainers have gotten a lot of attention, and we should be clear-eyed about where they actually are in the competitive landscape today versus where they might be in 5 or 10 years. Right now, no electric or hybrid trainer has the range, the endurance between charges, the service network, or the certification history to serve as a direct substitute for an Archer in a professional training program running a full instrument curriculum. That doesn't mean it won't happen eventually, and it doesn't mean Piper isn't paying attention to where that technology is headed. But it does mean that the fleet purchases happening today, the ones driving Piper's current expansion in the school market, are not being meaningfully delayed by schools waiting to see if electric trainers mature. Schools need airplanes now. The training pipeline doesn't pause for next-generation technology to catch up with real-world operational requirements. This is actually worth dwelling on for a moment, because the gap between the exciting narrative around electric aviation and the mundane but urgent reality of the training pipeline is one of the most important disconnects in this industry right now. The exciting version of the story is that electric trainers are coming and they're going to transform flight training economics with dramatically lower per-hour operating costs. The mundane but operationally real version is that a school has 72 students enrolled right now who need cross-country hours and instrument approaches and multi-engine time and can't wait 3 years for a charging infrastructure and certification picture to mature. Piper is selling into the mundane version, and the mundane version has the money. Now, I want to take a closer look at what this expansion tells us about demand durability, because this is the question that matters most if you're thinking about this industry with any kind of long-term perspective. One of the risks in reading the current training demand surge is misreading it as a purely cyclical phenomenon that will reverse when the airline shortage conversation calms down. I want to push back on that reading pretty firmly, for a few specific reasons. First, the demographic and structural drivers of the airline pilot shortage are not short-term cyclical factors. They're the result of mandatory retirement ages eating into a bulge of pilots who were hired in the expansion years, combined with military pipeline changes that reduced the flow of experienced military aviators into civilian careers, combined with the long trough in commercial aviation hiring following September 2001 that created a multi-year gap in the career ladder that's still working its way through the system. These are not conditions that correct in a couple of years. The structural pipeline deficit is a decade-long or longer story, and the training demand that results from it is similarly durable. Second, the international component of training demand is not tied to the U.S. airline hiring cycle in the same way the domestic component is. Global commercial aviation growth, particularly in Asia and the Middle East, is a long-term structural story driven by rising middle classes, expanding route networks, and national carriers that are growing their fleets faster than they can hire trained flight crews domestically. As long as American flight schools are a destination for international students, which they will be, as long as the training infrastructure here remains strong, that demand thread is relatively independent of what's happening at United or Delta's pilot recruiting desk on any given quarter. Third, and maybe most importantly for the training aircraft market specifically, the fleet age problem we talked about earlier doesn't go away if enrollment flattens. Old airplanes still need to be replaced. Maintenance economics still compound. A school that's running a 40-year-old fleet right now has a fleet replacement need that exists independent of whether enrollment is growing, holding, or even declining modestly, because the economics of maintaining truly aging trainers eventually become unsustainable regardless of how many students you're putting through them. Piper is selling into that replacement cycle as well as into the enrollment growth, and those two demand streams are at least partially independent, which gives the sales picture more durability than a single driver story would have. Let me talk about the economics from the school operator's side for a moment, because this is where you really see why Piper's move is well-timed and why the demand signal is likely to sustain. Running a flight school is a genuinely difficult business. The capital requirements are heavy, the liability exposure is real, the regulatory burden from the FAA is constant, and the operating margins at the training rate level are thin enough that almost any unexpected cost can hurt. Historically, that economic reality pushed schools toward the path of least resistance on fleet management, which was to keep flying old airplanes as long as they passed inspection, rather than taking on the capital commitment of new fleet acquisitions. The math of a new airplane acquisition is only compelling when the alternative, keeping the old fleet flying, costs enough in maintenance and downtime that the financing payment on a new airplane is genuinely competitive on a per-flight hour basis. That threshold has moved in favor of new acquisitions at a lot of schools right now, and not in a small or marginal way. The maintenance cost trajectory on aging airframes has steepened. Parts for old Lycomings and Continentals and high-time training configurations are not getting cheaper. The opportunity cost of an airplane sitting in the shop during a week of peak enrollment is higher than it used to be because you have more students competing for fewer available airplanes. And the warranty profile of a new airplane, combined with the predictable maintenance schedule in the early years, has real cash flow value to an operator who's trying to manage a budget without blowing a line item on an unexpected overhaul. When you model it out at a school with genuinely high utilization, the total cost of ownership comparison between an older airplane and a new one has shifted, in some specific cases, meaningfully toward new, in a way it simply didn't 5 years ago. Financing terms matter here too, and I don't want to skip past them. New aircraft financing for qualified institutional borrowers, which is how most schools with established credit relationships access it, is different from personal aircraft financing in some important ways. The rates schools can access through manufacturer financing programs or through aviation lenders that specialize in fleet transactions aren't always the same as the retail financing rates that affect private buyers. Piper, like most manufacturers, has financing relationships that can be structured in ways that reduce the month-one cash impact for a school making a fleet commitment. And when you're making a purchasing decision at the institutional level rather than the individual level, those structures matter. The fact that Piper is actively marketing into the school segment means they're offering these structures, which makes the new airplane math pencil out for a school operator in a way that it often doesn't when a private buyer is running the same calculation. Now let's talk about what this tells us about Piper as a company and where they're placing their strategic bets, because that part of the story is genuinely interesting. Piper has had a complicated few decades. The bankruptcy in the early 90s was followed by a long rebuilding process, a period of ownership changes, and a reconfiguration of the product line that narrowed the company's focus considerably, compared to what it had been in the volume years of the 70s. For a while, Piper's survival felt genuinely uncertain to people watching closely. The company that emerged from that process was leaner, more focused, and more clearly dependent on specific market segments rather than the broad general aviation market that had kept multiple manufacturers busy during the peak years. That leaner focus turned out to be strategically intelligent in a way that wasn't obvious at the time. By concentrating on the training market and on the market for serious cross-country and IFR-capable piston aircraft, rather than trying to compete across every segment, Piper built a deep and durable relationship with the institutional buyers that turned out to be the most stable source of demand in the broader general aviation market. Flight schools don't go away when discretionary spending gets tight the way personal airplane buyers do. Airlines don't stop needing pilots when economic conditions are uncertain. The institutional training market is not recession-proof, but it's meaningfully more resilient than the discretionary personal aircraft market, and Piper's concentration there has become an advantage rather than a limitation. The current expansion into the school market isn't a pivot or a new strategy. It's a deepening of a bet that Piper has been making for a long time, made at exactly the moment when the payoff for that bet is most visible. This is a company that knows its customer, has been investing in that customer relationship for decades, and is now harvesting the returns of that investment in an environment where the customer has never needed what Piper sells more urgently than they do right now. That said, Piper isn't operating without challenges, and I think it would be doing a disservice to the complexity of this story to tell it as a clean success narrative without acknowledging where the friction is. Production capacity is real. You can't ramp up manufacturing of certified aircraft as quickly as you can ramp up manufacturing of consumer products, because every aircraft requires FAA oversight, quality control processes, documentation, and time that simply can't be compressed beyond certain limits. When demand accelerates faster than production capacity can scale, you get lead times that stretch, delivery delays that frustrate school operators who are making enrollment commitments based on expected fleet availability, and potential for a competitor to capture a sale that Piper would otherwise close if they could just deliver the airplane faster. Managing production capacity in this environment is one of the genuine operational challenges Piper faces, and it's one where getting it wrong has real commercial consequences. Labor is part of that capacity picture. Skilled aircraft assembly workers aren't abundant, and training them takes time. Quality control in aircraft manufacturing is not something you shortcut. Piper has been working at managing this constraint, but it's a real one, and it puts real limits on how fast they can respond to the demand signal they're currently seeing. This isn't unique to Piper. It's a systemic challenge across certified aircraft manufacturing right now. But it does mean that the visible demand they're capturing is probably still undershooting the actual demand in the market. Because schools that need airplanes now and can't wait 18 months for a delivery slot are sometimes forced to look at alternatives, including extending the life of older airplanes they were hoping to retire, not because they prefer that outcome, but because they don't have a better one available. Pricing is the other friction point worth being honest about. New Archers and Seminoles are not cheap. The fully equipped school version of an Archer TX is a genuine capital commitment for any school that isn't a large, well-capitalized operation, and for smaller regional schools with limited access to institutional financing, the economic calculus of new versus used isn't always as favorable as the maintenance math alone would suggest. Some schools are buying new. Others are buying used trainers from larger schools that are themselves upgrading, which creates a secondary market dynamic that Piper doesn't directly benefit from, but that still speaks to the overall demand for trainer capacity in the system. The used trainer market is worth acknowledging because it means the total demand for training aircraft is being served by both new production and used aircraft trading through the secondary market, and both of those flows matter for understanding where the industry actually is. Let's spend a few minutes talking about the instructor side of this picture, because airplanes without instructors don't train pilots, and the instructor market right now is doing something interesting that connects directly to the aircraft demand story. The flight instructor shortage is real, and it's well documented, but it's also misunderstood in an important way. The shortage of flight instructors at flight schools isn't primarily a shortage of people with flight instructor certificates. It's a shortage of people with flight instructor certificates who are choosing to stay at flight schools rather than moving on to regional airlines on the accelerated timeline that hiring has enabled. The CFI career path has historically been a stepping stone, a way to build hours toward an ATP while earning some income, rather than a long-term career destination. When the airline hiring environment is so hot that a low-time CFI can build to ATP minimums quickly and get hired on an attractive timeline, the average tenure of a flight instructor at a school decreases, which means schools are constantly recruiting, training, and replacing instructors at a pace that is genuinely disruptive to continuity. This has a counterintuitive relationship to the aircraft demand story. Schools dealing with high instructor turnover are paradoxically sometimes less able to utilize additional aircraft capacity effectively because adding airplanes to the ramp without adding instructors to fly them doesn't improve throughput. What it creates is a situation where some schools have more airplane capacity than their current instructor count can efficiently use, while simultaneously being unable to meet their enrolled student demand because they can't get enough instructors in the seats. Adding Pipers to the ramp doesn't solve the instructor problem, but what it does do is give a school that is successfully building its instructor count the physical capacity to scale throughput as that instructor base grows, rather than hitting an airplane bottleneck on top of the instructor challenge. Schools that are managing the instructor situation well are buying airplanes in anticipation of being able to use them as their staffing catches up, which tells you something important about how bullish they are on their own enrollment trajectory. There's a longer-term dynamic here worth mentioning too, which is the question of what happens to the instructor shortage as the hiring environment at regional airlines eventually normalizes. At some point, ATP seat demand has to level off. It won't grow forever at the current pace. When the urgency to move from flight instruction into airline flying decreases somewhat, more CFIs will stay at schools longer, average instructor tenure will increase, and the churning instability in school staffing will moderate. That's not necessarily a near-term story, but it's a real one, and when it plays out, schools that have invested in modern fleet capacity will be well-positioned to capitalize on the improved staffing stability. Piper is, in a sense, selling airplanes to the version of these schools that they expect to be in 3 to 5 years, as much as to the version they are today. Let me bring this around to what it means from an investment and market signal perspective, because the fleet expansion Piper is executing isn't just a story about airplanes. It's a story about capital allocation in response to durable demand, and that story has implications that reach further than any single manufacturer's sales figures. When a certified aircraft manufacturer commits production capacity to the training market at scale, they're making a multi-year bet. They're tooling lines, hiring workers, securing supply chain commitments, and building dealer and service infrastructure around the assumption that demand will sustain at sufficient levels to justify those investments. They're not making that bet lightly. The lead times in this business are long enough that a decision made in the wrong direction has consequences that take years to unwind. The fact that Piper is making this bet, visibly and at meaningful scale, tells you something important about the quality and durability of the demand signal they're seeing. This kind of forward-leaning capital commitment by a manufacturer is one of the most reliable leading indicators we have in this industry for where real activity is actually headed. Marketing can tell you what a company wants to be true. Production investment tells you what their actual analysis of customer demand looks like. And right now, Piper's production investment is telling you that the training market in the United States is robust, is growing, and is expected to stay that way for long enough to justify fleet-level manufacturing commitments. Now, what are the broader implications of this for various stakeholders in the ecosystem? Let me work through this methodically, because it's worth being specific. For students in professional training programs, Piper's fleet expansion is unambiguously good news in the medium term. More training aircraft in the system means more capacity, which means less competition for block time, potentially shorter time to complete training milestones, and potentially better negotiating position on training rates as supply of available training hours increases relative to demand. Glass panel standardization across more of the fleet also means better avionics familiarity coming out of training, which is a genuine competitive advantage at the interview table. The near term is still constrained because delivery timelines are real, but the directional trend is toward more capacity rather than less, and students who are planning a training trajectory 2 or 3 years out should be factoring that improving capacity picture into their planning. For school operators, the expanding fleet availability from Piper creates opportunity, but also competitive pressure. If your well-run competitor down the road adds 6 new Archers with G1000 NXE panels to their fleet, and you're still running 15-year-old glass retrofits, you have a positioning problem when a prospective student is comparing schools. Modern fleet is becoming a competitive differentiator in a way it wasn't when everyone was running old equipment. That pressure is already visible in the marketing language schools are using to recruit students, and it's going to intensify as more schools complete fleet upgrades. For operators who have been putting off the conversation because of the capital commitment, the window to upgrade before it becomes a disadvantage rather than an advantage is narrowing. For the used trainer market, Piper's fleet expansion has a nuanced effect that's worth thinking through carefully. On one hand, schools that upgrade to new aircraft generate supply in the used market as their old equipment trades out, And that supply can benefit smaller schools, flying clubs, and individual buyers who want a more affordable path to a decent training platform. On the other hand, as more of the institutionally operated fleet moves to current generation glass avionics, the used market for older analog panel trainers gets stratified more sharply. An older analog 172 or Cherokee with a well-maintained engine and fresh paint has a buyer, but that buyer is increasingly someone whose mission doesn't require the training pedigree of a full glass panel. The subset of used trainers that commands a premium, the ones with G1000 installations or comparably current avionics, gets pulled by new production pricing in one direction, while the older analog aircraft chart their own separate market trajectory. If you're selling out of a training fleet, the model year and avionics suite of what you're selling matters more right now than it did 5 years ago. For the regional airline hiring picture, which is ultimately the downstream beneficiary of everything we're talking about, Piper's fleet expansion contributes to a capacity story that gives the pipelines a better chance of actually meeting demand. More training aircraft means more pilots can progress through training simultaneously, which means more ATP-eligible pilots entering the market over the next few years. It won't solve the shortage on its own, because the shortage is multidimensional and aircraft supply is only one constraint among several. But it removes a constraint that was real and limiting, and constraint removal at this point in the pipeline is exactly what the downstream hiring environment needs. I want to spend a few minutes on a dimension of this story that I think gets almost no attention, which is the international competitive positioning of U.S. flight training, because it's connected to the Piper expansion in ways that are worth understanding. The U.S. flight training market competes globally for international students. Not explicitly, not in a way that gets managed by any central authority, but in practice, a family in Vietnam or India or Brazil making decisions about where to send a student for professional flight training is choosing between programs in the United States, Australia, Canada, South Africa, and several European countries. The quality of the training aircraft fleet is part of what goes into that decision. Schools running modern glass panel fleets and well-maintained airframes attract international students who are making a very significant financial commitment and want confidence that they're getting preparation that will be recognized globally. As Piper's expansion modernizes more of the U.S. training fleet, it incrementally strengthens the competitive position of U.S. schools in that global recruitment competition, which in turn sustains the international enrollment that's a significant portion of total training demand. This is a feedback loop worth recognizing. International enrollment sustains school revenue and enables further fleet investment. Fleet modernization attracts more international enrollment. Piper sits right in the middle of that loop, as the supplier of the physical assets that make it go. Their expansion isn't just responding to demand, it's participating in the conditions that sustain and grow that demand over time. Let me address something that a careful listener is probably already thinking about, which is whether this demand picture can continue long enough to justify what Piper is betting on, or whether there are visible risks that could interrupt it. The most obvious risk is a significant economic downturn that reduces airline travel demand, which in turn reduces airline growth, which reduces hiring pressure, which reduces the urgency driving professional training enrollment. This chain of causation is real, and aviation is not immune to macroeconomic cycles. The 2001 and 2008 downturns both hit airline hiring hard and hit training enrollment as a consequence. If a comparable downturn materializes, some of the urgency currently driving training investment will abate, and schools that made capital commitments based on peak cycle demand will feel that abatement. This is a real risk, not a hypothetical one, and anyone making long-term decisions in this space needs to think clearly about it. That said, there are reasons to think the structural floor on training demand is higher than it was in previous cycles, specifically because of the severity and duration of the current shortage relative to historical patterns. Even in a downturn scenario where airline growth slows, the existing deficit of pilots relative to current fleet needs is large enough that hiring doesn't simply stop, it slows. And in a slowdown, the pressure on training timelines eases, but doesn't disappear. That's meaningfully different from a scenario where training demand drops back to pre-shortage levels, because the baseline that demand would fall back to is higher than it was before the shortage built to this severity. The other risk worth mentioning is technology disruption from the electric trainer category. We've already talked about where that technology actually is today versus the marketing narrative, but it would be incorrect to suggest it's irrelevant to Piper's long-term position. 5 years from now, if electric trainers achieve meaningful certification milestones and charging infrastructure at airports develops materially beyond its current state, some of the market that Piper currently serves with Archers starts to look more contestable. Piper is aware of this, and the relevant question is whether their current bet on traditional piston trainers generates sufficient return before that competitive landscape changes materially. Given where electric certification actually is right now, there's a reasonable case that the piston trainer window stays open for at least another 5 to 8 years of meaningful volume, which is enough runway to justify the current investment if the underlying demand holds. Beyond that window, the picture becomes genuinely uncertain in ways that are honest to acknowledge rather than paper over. There's also a risk on the production side that I mentioned earlier and want to return to briefly, which is the risk of overshooting on production capacity if the demand signal turns out to be somewhat overstated. Manufacturing scale-up is expensive and slow to reverse. If Piper builds out for a demand level that doesn't fully materialize, they face the reverse problem from what they're dealing with today: excess capacity and the cost burden that comes with it. The right way to think about this is that Piper is trying to read a demand signal that is genuinely strong and visibly backed by real orders, while also being careful not to mistake peak cycle urgency for secular trend. Getting that calibration right is the central operational challenge for their management team right now, and there's no way to do it perfectly because no one has a reliable crystal ball for demand 2 and 3 years out in a sector this complex. None of that changes the fundamental read on what the current fleet expansion says about training demand. The signal is real, the demand is real, the structural drivers are durable in most of their relevant dimensions. Piper is reading correctly that now is the right time to be pressing into the school market rather than pulling back from it, and the schools that are buying are making that purchasing decision based on enrollment reality and fleet economics that are genuinely compelling right now. What I want to leave you with is a zoomed-out perspective on what this particular story tells us about where the training pipeline sits in the broader general aviation ecosystem, because I think it